Well, it's 12 o'clock, so we need to get started. I guess we're still missing 3 people. Today, we're going to take a look at dividends. Let me share the screen. And I think last Friday, or Wednesday rather, we finished taking a look at preferred stock transactions. I know we looked at the treasury stock. Maybe we didn't take a look at this preferred stock.
I don't remember that chart on
Okay.
preferred stock.
All right, so let's pick up there then. Not every corporation has preferred stock. All corporations have to have common stock because that's the voting shares. And without them, they couldn't function as a corporation. Preferred shares do not normally have voting rights. Preferred shares have priority over common shares for dividends and for the distribution of assets should the company liquidate. I think we talked about this slide anyway. Preferred dividends, although they have priority over common stock dividends, are not guaranteed. So preferred means that if they're going to pay a dividend, they can't pay a dividend to the common shareholders until they've paid the preferred shareholders the specified amount of their dividend. But that doesn't mean that they always have to pay the preferred dividend. If they don't have profits, if they don't have enough cash, then they do not have to pay the preferred dividends. Anytime it would impair their ability to pay back their creditors, they should not pay the preferred dividend. So Eastern Data Link sold 2 million $1 par common shares for $9 a share and issued 40,000 common shares to attorneys in exchange for legal services. The additional paid-in capital account is also called paid-in capital in excess of par. So $2 million times $1 par plus 2 million plus 40,000 is 2,040. 2,040,000 shares, $2,040,000 par for the common stock. And then legal expenses, will assume that it was $9 a share times 40,000 shares. So they debit legal expenses 360. They sold 2 million for 9, so that's 18,000. 18 plus 360, or 18 million minus the 360,000. Let me start over again. 18 million plus the 360 is how much they brought in. Of that, 2,040,000 was the par value. So the difference between the cash and legal expenses and the par value is additional paid-in capital common. So then they sold $4,050 par preferred shares for $56.25 a share. So 4,000 shares times $50. The par value of the preferred stock is 200,000. Cash 4,000 times 56.25. Debit cash 225,000, and the difference is additional paid-in capital preferred. The textbook has separate accounts for each different source of paid-in capital. So here they had paid-in capital common, additional paid-in capital common. Here it's additional paid-in capital preferred, but actual financial statements typically combine them all into one line. Dividends. Dividends are an optional return of profits to the owners of the corporation and are not an expense. Some corporations never pay dividends. So on the chat before we went to this PowerPoint, I asked the question, if some corporations never pay dividends, why would investors want to buy the shares? Any ideas? What's the main reason why investors buy shares of stock? Do they do it because it's fun? It might be for some, but that's not the main reason. The main reason is that they're hoping that the price of the stock will go up in the future. So they're hoping to be able to sell it for a higher price in the future and get a capital gain. So dividends are one way of getting money from a stock investment, but most investors are more interested in capital gains. So let's go back to, let me, let's go back to the share screen. Cash and property dividends are returns of profits to the shareholders. So they earn money, and when they have profits, they have two choices in how to use the profits. They can return it to shareholders or they can reinvest it. A stock dividend, which we'll talk about later, is not a return of profits to the shareholders. There are three dates involved for dividends. The first date is the declaration, and the declaration date is when the board of directors makes a public announcement that they're going to pay a dividend. The second date is the date of record. On the date of record, whoever owns the share of stock when the market closes that day is the one who will get the dividend. And then distribution is when they mail the checks or do a direct deposit. So they have to be in this order. First declare it, then the date of record, then the distribution. Dividends are almost always paid in cash, but distributions of other assets are possible. Property dividends may consist of stocks or bonds of other companies or of other assets. When cash dividends are declared, debit retained earnings and credit dividends distributable, which is a liability. And many companies use the account name dividends payable or cash dividends payable. They don't call it dividends distributable, but they're all three the same. And it's a liability because the board of directors is saying, we're going to pay you. And once they make that promise, they have to put their money where their mouth is. So it creates a liability. When cash dividends are distributed, then you would debit the liability account, whichever of these three names is being used, and credit cash. So here is a real life example. On July 30th, 2019, Apple's board of directors has declared a cash dividend of 77 cents per share of the company's common stock. The dividend is payable on August 15th, 2019 to shareholders of record as of the close of business on August 12th, 2019. The June 29th balance sheet attached to the press release reported 4,531,395 shares of common stock issued and outstanding. So there's 3 dates involved, and the entries would be as follows. 4,531,395 shares times 77 cents a share is $3,489,174. So rounded to the nearest thousand on the date of record, or date of the announcement date, declaration date, July 30th. They announce the dividend and debit retained earnings, credit dividends payable, 3,489,000 rounded to the nearest thousand. Date of record, they figure out who owns each of the shares, all 4,431,395 shares, when business is closed on August 12th. But they don't owe anymore. They haven't made a payment, so there's no journal entry. Then 3 days later, they know where the money goes, so they make the payment and credit cash, debit dividends payable for 3,489,000. So you see here, the liability is created when they announce the dividend and eliminated when they make the payment. And you should know all 3 names for that liability. Questions about that? Then let's go to property dividend next. Property dividend is where they pay a dividend out of profits, but they're not using cash. So this is based on brief exercise 1812. Adams Moving and Storage declared a property dividend of 1,000 shares of GE stock that had been purchased at a cost of $37,000. On the date of declaration, the GE stock had a market value of $35,000. So since it had been purchased for $37,000 and was now worth $35,000, first they're going to adjust the carrying value of the stock by recording a $2,000 loss, the difference between the cost and the current market value, because what they're going to distribute is worth $35,000, but it's on their books for $37,000. So they bring their books up to date, record the loss, and now they record the liability to pay the dividend, $35,000, 1,000 times $35, and then subtract $35,000 from retained earnings. Then on the date of distribution, they debit property dividends payable for $35,000 and credit investment in GE stock for the remaining $35,000. It had been on their books at $37,000 minus a $2,000 loss, $35,000 remained in the account. Questions or comments on that before we move on to the next one? Then let's take a look at this exercise here, which is allocating cash dividends. The shareholders' equity of a company had 8% preferred stock, cumulative non-participating. Excess of par on that was 555 million. The par value of the preferred stock is 200 million. Common stock par 100 million. Additional paid-in capital on it 980. In year one, the board of directors declared a cash dividend of 8 million. Excuse me. In year two, 20 million, and in year three, 150 million. So they want us to determine out of those three cash payments, how much went to the preferred shareholders and how much went to the common shareholders each year. So the preferred stock has a total par value of $200 million and pays a dividend of 8%. So the annual dividend should be $16 million. And that means that they can't pay anything to the common shareholders in a particular year unless they pay the 16 million first to the preferred shareholders. Cumulative means that if they miss the dividend, the next year they have to pay that year's dividend and anything missed previously before common shareholders can get a dividend. So in year one, if all they pay is $8 million, then all of it has to go to the preferred shareholders. So they pay 8 goes to the preferred, and that means that the preferred stock is 8 million in arrears. That means past due, not paid, owed 8 million. And now it's not an actual liability because they don't have to pay the preferred shareholders anything ever. But before they can pay anything to the common shareholders the next year, they have to take care of that missed $8 million. So in year two, they paid 20 million. And that means that they paid for 16 million that they're supposed to pay for this year. And then another 4 million reduces the amount that's in arrears. So 8 minus 4 is 4 still in arrears. So nothing goes to the common shareholders the first 2 years. Money was tight. Year three, it looks like they've made a lot of money and they're declaring a huge cash dividend of $150 million. So the preferred shareholders get their $16 million for year three, plus the 4 that was in arrears from the previous year, and that's all they get, the 20. All the rest of it goes to the common shareholders. So based on that discussion, on that analysis, would you think that preferred stock is riskier or less riskier than common in terms of dividends? I saw Nancy's mouth move, but her mute is on.
I think it's riskier.
Okay, so that's because whatever risk the preferred shareholders have is included for the common shareholders plus more, right? Because they can't get anything until preferred shareholders are paid. On the other hand, if the company's really doing well, then the common shareholders are really getting a lot of dividends in that year, way more than the preferred. So the return might be higher to attract them, but it's still riskier. Okay, let's go to next slide, which is comparing some things. And we're comparing cash dividends to stock dividends and then to stock splits. So a cash or a property dividend returns profits. Stock dividends increase the number of shares. They're not giving anything to a shareholder. The company's being divided up into more shares. Stock splits increase the shares like stock dividends, but they increase the shares by such a large amount that they have to change the par value. So, reasons for stock dividends and splits. First reason is share affordability. And what happens, you've seen when the stock market's doing well, the price of a share of a company's stock gets higher. Well, it could get higher and higher and higher and higher. So if you're an investor and you have $10,000 to invest in a portfolio of stock, you might look at a whole bunch of different stocks and buy them. And you're not going to buy the one share of a company that costs $10,900 because you only have the $10,000 to invest, and you don't want to put all of your eggs in one basket and have a risky investment. So if share prices get to be too high, investors don't like it. They can't diversify. It's too risky. So some companies will increase the number of shares with stock dividends or stock splits. That means the same company is divided by more shares. Each share becomes a smaller percentage of the company. And so its market price decreases even though investors are actually losing anything, because the investors have shares that cost less, but now they have more shares, so they're no better or worse off. Second thing is to signal investors. When a company makes a stock dividend, they have to debit retained earnings as part of the accounting entry. And if they debit retained earnings for a stock dividend, it means that there's just that much less retained earnings to debit for cash dividends. So they're telling investors that they can't or won't be paying cash dividends. Why are they keeping their cash? Even if they're making a large profit, it might be that they have something that they want to invest in. So it's a signal to investors about their plans for investments in the future. Second, or the third reason for stock dividends and splits is to trick a naive investor into thinking that they're getting something. Oh boy, I got a cash dividend. Well, so what? You're not any better off. If you have a cash dividend, the amount of money that your investment is worth, if you got a stock dividend rather, it's pretty much the same before and after. So I'm going to go to the whiteboard. And do a diagram. Share screen, whiteboard. Okay. All right, let's see. We want draw. Text. Company's assets of $1 million. Liabilities, $500,000. Therefore, the shareholders' equity equals what?
500,000.
Okay, 500,000. And the company has 100,000 shares of stock. Therefore, the book value of each share, $5. You with me so far? Now, you own 10,000 shares. Therefore, your total book value is $50,000. The company issues a stock dividend of 20%. So now there are 120,000 shares, and the book value per share is 5 million divided by 120,000 equals it's not 5 million, it's 500,000, isn't it? So let's try that again. 100 divided by. Rounded to the nearest cent, $4.17. Now, how many shares do you have? 12,000 shares. Each $4.17. But I'm not going to round it when I do the calculation. I'm going to keep what's in my calculator that carries it all the way out times 12,000 shares So now your book value is $50,000. Now, I'm assuming since nobody said anything that you can see the whiteboard as I did the numbers and the calculations. So questions about this. This is an important concept to understand. When there's a stock dividend, the investors aren't really any better off. Now, here's a possibility. Sometimes because of signaling and because of share affordability, the market price might go up just a little bit because of the stock dividend. But that's incidental. That increase in wealth didn't come from the corporation. It wasn't a return of profits. Questions about that? So, go ahead. I thought I heard someone ask a question. Okay, then. Here's the other thing to point out. Before the stock dividend, you owned 10 out of 100,000 shares, 10%. After the stock dividend, you had $12 out of 120,000, or 10%. So it didn't change your overall holding of the company. Okay, so let's go back to the PowerPoint. And here's the illustration of a common stock dividend. Core Technologies declared a 10% stock dividend distributable on June 1st. That means that for every 10 shares that you own, you would get one new share. The market value on April 1st was $30 per share. 3 million shares were outstanding. The entries to record this. So they debit retained earnings times 3 million times 10% times $30 market value. Debit retained earnings for $9 million. Credit common stock distributable, 3 million shares times 10% times $1 par. And then the difference is paid in capital in excess of par. Then when they distribute them, they debit common stock distributable and credit common stock with a par value of $300,000. Questions or comments on that? Stock splits. Since the increased number of shares is offset by the decrease in par value, No entries are made for a stock split. For example, if a company with 1 million shares of $1 par value common stock outstanding, its total par value would be $1 million. If it had a 2-for-1 stock split, then it would have 2 million shares of 50-cent par value common stock. The total par value would remain $1 million. Next thing is a stock split affected in the form of a stock dividend. And that a stock split affected in the form of a stock dividend is a hybrid between a stock dividend and a stock split. It's essentially such a large stock dividend that the market values of the stock are ignored since they're going to drastically change as a result. In exercise 1820, Hanmi Financial Corporation announced a 100% stock dividend. So every share you had before becomes 2 shares now. It had 24.5 million shares of the par value of 1 cent, 1/10 of 1 cent. So the par value of the shares to be issued would be 24.5 million times $0.001 is $24,500. So they debit paid in capital in excess of par, credit common stock distributable for the $24,500. And when they distribute it, debit common stock distributable, credit common stock $24,500. Before the split, Hanmi's market price per share was $36. After the split, we would expect it to be about $18 since each share is half the size as before. So the total market value of the stock would remain about the same, and we're not going to use the paid in capital in excess of par account. And the reason I said about, market values often do not adjust completely because investors like stock dividends and stock splits. And the stock may now be more affordable and thus more attractive. So it's possible that the new price might be a little higher than $18. Questions before we move to the next topic, which is fractional share rights? Okay, fractional share rights. If a 4% stock dividend is issued and you have 100 shares, you would get 4 shares. If you have 25 shares, you would get 1 share. But what if you have 10 shares? You can't get 4/10 of a share. There's no such thing as a fraction of a share of ownership. 1 vote per share. You can't get 4/10 of a vote. So the corporation issues fractional share rights to those shareholders who would get only partial shares. So instead of getting 4/10 of a share, they're going to get a check. The corporation will pay cash to those who had fractional share rights. So here's an illustration. DMD Corporation had 900 million shares of $1 par common stock outstanding. The market value is $21 per share. A 4% stock dividend was declared and distributed. Fractional share rights adding up to 2 million whole shares are paid in cash. The entry for the declaration and distribution of the stock dividend and the fractional shares. So instead of having one entry for the declaration and then a second entry for the distribution, this nets them together and shows the overall result when it's all over and done with. So retained earnings is the 900 million existing shares times 4% times the $21 market value. So they debit retained earnings for $756 million. No, that would be 1,000. Yeah, million. Common stock, 36 million shares would have been issued. That is 900 million times 4% is 36, but 2 million of them were fractional little pieces, so they are not going to get common stock, they're going to get cash. So 34 million times $1 par, credit common stock for $34 million. Cash, 2 million shares, they're paid for whatever fraction of it they have, they're paid a check for $21 market value. And then subtract the 34 and 42 from the retained earnings of 756 to get paid in capital in excess of par of 680. Reverse stock split.
I have a question.
Yeah.
Do we need to know how to calculate fractional shares? Like how many there will be? Is that part of something we should know?
If there's a homework problem like that, then they'll have to tell you.
Okay.
In real life, that's something that the company's accountants are going to have to do. They're going to have to figure out who all of the shareholders are, how many shares each individual shareholder owns, and how many of them will end up not getting a full share in the distribution.
Sounds pretty brutal.
I think that they're going to have, I can't imagine how they did it in the old days before computers. It probably took at least a couple weeks to calculate. And I think in those days, the time between the date of record when they start counting and the date of distribution was longer than it is now. You saw in the Apple example that it was 2 days. I don't think they could have done that manually in 2 days. Okay, so reverse stock split. Company decreases its outstanding shares. After a 1-for-4 reverse stock split, for example, 100 million shares, $1 par per share would become 25 million shares, $4 par per share. No journal entries necessary. Of course, the market price per share theoretically would quadruple, which usually is the motivation for declaring a reverse stock split. Companies that reverse split their shares frequently are struggling companies trying to accomplish with a split what the market has been unwilling to do, increase the stock price. Often this is to prevent the stock's price from becoming so low that it is delisted from a market exchange. And what they mean by that is if you're on the New York Stock Exchange and something catastrophic happens to your company, and instead of selling like it was selling at $10 market value per share, people are now trying to sell it for 7 cents. They're just going to take you off the stock exchange. And that's called delisting. You won't be registered with that stock exchange anymore. Reverse splits are not unusual occurrences, particularly during stock market downturns. In 2017, Xerox declared a 1-for-4 reverse split. Okay, that ends a topic. The next topic is stock options. That's really quite different than what we've been talking about so far. And this is our last unit. I think we're doing pretty well. We should be able to finish in time for the end of the semester. So we're just about out of time now. So any questions that you have before we close for today? Remember, your final exam is going to be a quiz on Canvas, multiple choice. I've started preparing it. It's going to be the biblical integration parts from all of the different PowerPoint, all 7 of them. So when I finish preparing the quiz, I'll give you a study guide so you'll know what to expect on the final exam. So I've got that started, maybe 10 or 12 questions on there so far. So take care, be very careful, and I'll see you again on Friday. Bye now.